Welcome back, investors. Today we're diving into the fascinating world of investing and shining a spotlight on one of the most iconic figures in the finance realm, Peter Lynch. Before we get started, we kindly ask that you like the video and subscribe to our channel for weekly stock tips and personal finance advice. We're a new channel, and you subscribing is very important to us to let us know that you want us to continue providing more valuable information to you. Now, let's get started. If you ever wondered who Peter Lynch is and what makes his investment strategy so legendary, you're in the right place. Whether you're a seasoned investor or just starting out, understanding Lynch's approach can provide valuable insights into navigating the stock market. So, who exactly is Peter Lynch? Born in 1944, Lynch is a renowned investor and former mutual fund manager. He's best known for his tenure as the manager of the Magellan Fund at Fidelity Investments, where he achieved remarkable success. Under Lynch's leadership, the Magellan Fund consistently outperformed the market, averaging an impressive annual return of 29.2% during his 13-year tenure. Every $10,000 invested with Lynch at the beginning of his tenure was worth $280,000 when he retired from managing the fund. This track record earned him a reputation as one of the most successful investors of all time. Now, let's talk about one of Lynch's most famous concepts, the 10-bagger. A 10-bagger refers to investment that increases in value tenfold, meaning you've made 10 times your initial investment. Lynch was a master at identifying these opportunities, often investing in relatively unknown companies with significant growth potential. What exactly did he look for in those growth stocks that had the potential to become 10-baggers? Let's find out. Firstly, Lynch believed in investing in what you know. He famously said, "Never invest in any idea you can't illustrate with a crayon." This means he favored companies whose products or services he could easily understand and visualize. For Lynch, this could be anything from consumer brands like Coca-Cola or Nike to innovative tech companies like Microsoft or Intel. Understanding the business model and the company's competitive advantage was key. Another crucial aspect Lynch looked for was consistent earnings growth. He preferred companies that were able to grow their profits steadily over time, indicating that they had a strong market position and were effectively executing their business strategies. Additionally, Lynch paid close attention to the price-earnings ratio. He preferred stocks with moderate PE ratios relative to their earnings growth rates, indicating that they were not overvalued compared to their growth prospects. Lynch also analyzed a company's balance sheet to ensure it had manageable debt levels and sufficient liquidity. He avoided companies with excessive debt burdens, as they could be more vulnerable during economic downturns. So, to recap, when it comes to growth stocks, Peter Lynch looked for companies with products or services he could easily understand, displayed consistent earnings growth, possessing reasonable valuations relative to earnings growth, and strong balance sheets. Lynch had a knack for finding hidden gems in the stock market. One of his favorite metrics for evaluating stocks was the PEG ratio. He was perhaps the first American investor to use the PEG ratio to determine if a company was undervalued or overvalued. So, what exactly is the PEG ratio? PEG stands for Price and Earnings to Growth Ratio. It's a valuation metric that takes into account a company's price-to-earnings ratio relative to its earnings growth rate. The formula for the PEG ratio is simple: PE ratio divided by the annual earnings growth rate. Essentially, it tells us how much an investor is paying for the expected growth of a company's earnings. For example, let's say a company has a PE ratio of 20 and an annual earnings growth rate of 15%. The PEG ratio would be calculated as 20 divided by 15, which equals 1.33. Now, here's where Lynch's genius comes into play. He believed that a PEG ratio of 1 indicated that a stock was fairly valued. A PEG ratio over 1 indicated that a stock was overvalued, and a PEG ratio under 1 meant that a stock was undervalued relative to its growth potential. By focusing on stocks with low PEG ratios, he aimed to identify companies that had both strong growth prospects and attractive valuations. The Investment IQ Insights team created a stock screen that we believe will help identify the types of stocks that Lynch might have picked for his portfolio that he thought had the best chance of becoming 10-baggers when he was actively managing the Magellan Fund. Next, we'll briefly discuss each criteria covered in the stock screen. Market capitalization, often referred to as market cap, is a measure of a company's total value in the stock market. It's calculated by multiplying the current market price of a company's outstanding shares by the total number of outstanding shares. When screening for the 10-bagger, smaller companies with market caps under $10 billion have a greater chance of becoming 10-baggers than companies with market caps above $10 billion. Earnings per share, EPS, is a financial metric that represents the portion of a company's profit allocated to each outstanding share of its common stock. It's calculated by dividing the company's net income by the total number of outstanding shares. Fast growers typically possess earning per share growth rates of 20% or more annually. For our 10-bagger screen, we look for an earnings per share growth rate of 20% for the most recent 5-year period. Return on equity, ROE, is a financial ratio that measures a company's profitability relative to its shareholders' equity. It's calculated by dividing a company's net income by its shareholders' equity. The return on equity indicates how efficiently a company is using its shareholders' equity to generate profits. For our 10-bagger screen, we want to see a return on equity that has averaged 15% or more annually for the most recent 5-year period. The debt-to-equity ratio is a financial ratio that compares a company's total debt to its shareholders' equity. It's calculated by dividing total liabilities, including both short-term and long-term debt, by shareholders' equity. We want a debt-to-equity ratio of 0.40 or less. The current ratio is a financial ratio that measures a company's ability to cover its short-term liabilities with its short-term assets. It's calculated by dividing a company's current assets by its current liabilities. The current ratio provides insight into a company's liquidity and its ability to meet its short-term financial obligations. Most financial experts think that a good current ratio is 1.0 to 1.2, but we feel more comfortable assigning a minimum current ratio of 1.5 to our stock picks. We've already talked about the PEG ratio in great detail, and with our screen, we like to see PEG ratios of less than 1 with companies that we think have the best opportunity to become 10-baggers. We also believe that most investors should stick to investing only in the stocks of U.S. companies until they've gained a lot of experience through investing. Only then should they consider investing in the stocks of foreign companies. When we ran our screen to see what stocks might fit the bill, we came up with a few that we really like and think they're currently worth a serious look. We'll discuss them next. We'll look first at MI Homes, stock symbol MHO. MI Homes is a leading home building company with a positive profile in the housing market. With a commitment to quality craftsmanship and customer satisfaction, MI Homes has established itself as a trusted brand in the industry. MI Homes' solid financial performance and strategic growth initiatives position it well for continued success in the dynamic real estate market. Investors may find MI Homes an attractive opportunity for its strong market presence, dedication to excellence, and potential for long-term growth. MI Homes' current market cap is $3.41 billion. The company's earnings per share for the most recent 5-year period stands at 34.35%. It also possessed an excellent average return on equity for its most recent 5-year period of 21.09%, with a very low debt-to-equity ratio of 0.36. MI Homes has a sky-high current ratio of 18.11. On February 9, 2024, MI Homes closed at a trading price of $122.36 with a PEG ratio of 0.60. Next, we'll look at UFP Industries, stock symbol UFPI. UFPI Industries is a dynamic and robust player in the industrial sector, renowned for its positive profile and solid performance. As a leading supplier and manufacturer of wood and wood alternative products, UFPI boasts a diversified portfolio catering to various industries including construction, retail, and manufacturing. With a strong financial record and a forward-thinking approach, UFPI presents investors with an appealing opportunity for potential growth and value appreciation. UFPI Industries' current market cap is $7.26 billion. The company's average annual earnings per share during the most recent 5-year period stands at 41.4%. Its yearly average return on equity for the most recent 5-year period stands at 21.61%. UFP Industries has a debt-to-equity ratio of 0.13 and a current ratio of 4.16. On February 9, 2024, UFP Industries closed at a trading price of $117.44 with a PEG ratio of 0.81. Finally, we'll take a look at Medifast Inc., stock symbol MED. Medifast is a prominent player in the health and wellness industry, known for its positive profile and commitment to helping individuals achieve their wellness goals. With a focus on science-backed solutions and personalized support, Medifast has built a strong reputation for efficacy and customer satisfaction. Its comprehensive range of products, including meal replacements and supplements, offers consumers convenient and effective options for achieving sustainable results. Medifast's robust growth trajectory, coupled with its solid financial performance, positions it as a compelling investment opportunity for those interested in the burgeoning health and wellness market. Medifast is the smallest of the 3 companies we covered, with a market cap of $595.47 million. Its average annual earnings per share for the most recent 5-year period stands at 40.93%. Its return on equity average for the most recent 5-year period is a scorching 76.37%. The company's debt-to-equity ratio is a super low 0.12, and its current ratio is 2.04. On February 9, 2024, Medifast closed at a trading price of $54.68 per share with a PEG ratio of 0.25. And there you have it, an introduction to the legendary investor Peter Lynch and his investment strategies. Remember to invest in what you know, focus on long-term growth, and always do your homework. Please remember to like this video and subscribe to our channel for weekly content on the best stocks to buy and winning personal finance and investment tips. Thanks for joining us today on Investment IQ Insights.